Hello, Warriors. Today is a special day. Anytime I have a chance to talk to Jack Schwager, it's to me an honor, and have learned so much from following Jack over the years and reading his books, and being able to talk to him is really one of the highlights of what I do. Jack, great to have you back. Really great.
Thanks, Sam.
All
Good to
right,
see you.
so yeah, so I was reading a piece that maybe you did a year ago, and you said that you keep in touch with the Wizards, and they had all done pretty well during the pandemic, because that was the time that the interview was done, I think, on Life with Traders. So
Yeah.
you know what, Jack? A lot of people did okay during the pandemic, unless they got COVID, right? Homeowners. You could have owned the SPY and thought you were a wizard for a few years. What I'm interested in is, once they took the punch bowl away and there was a regime change at the Fed, how are these guys holding up without a punch bowl behind them?
Yes. So actually, remarkably well.
Okay.
Actually, I was just compiling the numbers. So, because I did keep up, and this is only for, I'm just taking you off screen so I can just check in an Excel sheet I keep. This is only for the traders I interviewed in the last book that I've done this.
The unknown
Particularly
market
because
wizards.
we've had such dramatic markets. And as
Yeah.
you mentioned, this, one of the, most prolonged bear markets, actually, I guess, the most prolonged bear market since 2008. Let me see here. So I did check with all of them, and they, so basically, most of them still did fine. I guess I would break it down here that one break even, one slight single digit loss for a guy who's basically mostly long equity, not totally
Right.
long but equally biased long.
Okay.
So he was down little under 7%, which is not bad for if you're in equities.
Yeah, it beat the S&P by 25%. Being flat, you beat the S&P.
Yeah, well, whatever. I mean, the S&P, I forget what it ended up as, but it's probably by 15% better or whatever. And there's one couple of them did. No, one I don't have yet, but I think he had a very good year. But there's a couple in the 100% area. One in the 50% area.
Okay.
Now, here's an interesting one. Let me get back to the screen here. There's one who had his worst year by far, and I mean, a horrible year. I mean, percentage-wise, so like he's down over 50%. So now here's the thing, and there's a lesson here. There's a good lesson here. So I'll even mention the two traders, not a secret. So I'm sure he wouldn't mind my mentioning it. It's Chris Camillo. And Camillo, if you remember, is the guy who uses social arb to trade. Doesn't use fundamentals, doesn't use technical. He literally uses social arb. That's all he uses. And so he had a remarkable career, history. Going back to when he started trading full time, like in 2007 or so, I think, or 2006. And that's all in the book. What he did. So the question is how he did in the last 4 years, when I say 4 years. I interviewed him in 2019, so just taking that as that full calendar year as well, because I didn't have a full calendar year when I was interviewed. So anyway, the past 4 years, even though he's down like over 50% in 2022,
Right.
are by far the best of his entire career. Now here's the catch. When he was doing well, he was trading, his count was building. This year, things started to go off the rails, and I can even tell you why if you're curious. And he picked up on it. He saw, he understood what was going on. And so he cut the size. So he cut his trading size literally from the end of 21, late 21 to the end of 22, cut his trading count by literally tenfold.
Yes.
It's just so while he was losing, badly percentage-wise. He was losing it on a much smaller stake. He sort of wasn't going, and when he was doing well, he was putting his foot on the accelerator. So the period as a whole, he did phenomenal. And I calculated that he gave back, even though he had a plus 50% loss this year, he gave back literally only 13% of the profits he had made, and in the other 3 years. And that's a small amount considering what he had a remarkable year. I mean, his best year in that period, he was up like 350% or something. So
so it's a common thread. It's a common thread you bring up a lot, Jack, in your book, that the number one thing is risk management, right? So
this is under the umbrella of risk management, but it's a finer point. It's a more specific point. It's namely, it's not, traders are always focused just on, getting, where's the great place to get into trade? And if they're really sophisticated, how do you get out? But beyond those two things, it's also the size of the trade. Exactly. And varying the size of the trade is like a really, really critical thing. So in Camillo's is a classic example of that. So here he has a disastrous year, and it barely dents him. Why? Because things weren't going right. So he cut his trading side tremendously. You can go back to the first Market Wizards book. I believe Randy McKay was in that first Market Wizards book, and he talked about taking his contract, and he traded large. By the time I interviewed him, he was trading pretty large, but he would take literally on the CME, on say currency contracts. He'd have positions in the thousands of contracts.
Position limits.
So I don't know what the limit is on the currencies, or it was at that time, but he had sizable positions. But he talked about when things weren't going right, going down from 2,000 to 20. I mean, that's a big deal. That's 100 to 1, difference, right? So that is, I guess, in this little interview we're having now, that's kind of a key point that listeners can pick up, is that really pay attention to your trading size, and when things are not going right, cut. You could stop trading altogether. There's another solution. But if you want to, you're keeping going and you want to stay in touch with the market, fine, but do it on a much smaller side. Recognize that whatever you're doing, the market ain't on the same track, and that happens to all of us. And so that's, So, but how the traders did overall, they
reduce leverage.
Well, even with 2022, Miller was the only one that had had more than a single-digit loss, and in his case, he handled it fine because he only gave back a small amount of his profits.
Okay, so another key way of handling risk is leverage, and most people tend to over leverage. And I want to bring it up because you say that was a very important factor in Stanley Druckenmiller's success, that when he had high conviction on a trade, he went in big.
Yeah, I mean, he learned that. I guess he had it intuitively himself, but he credits Soros as kind of teaching him that lesson. It takes courage to be a pig, so to speak, and at the right time. And in Camillo's case, so he took, talk about, so that's exactly, talked about COVID, right? When the onset of COVID. So he started going short, through buying puts.
Right.
Mostly through buying puts, heavily. As the market was still going up in early March 2020, late February, early March 2020, or the first half of March 2020. And he was, kind of every week, he was buying weekly options and seeing his account go down by a few $100,000 every week, So, but he kept on taking these large option positions because he was just sure that he was right. Now, there's one thing about being stubborn, but some of these traders have methodologies where when they really have high conviction, they're right. And he was just sure he was right. And in fact, he says he wasn't 99%, he was 100% sure, even though the market was going against him. So So he took these large positions, and in a way that sounds like a contradiction to risk control, but it is in my job in the role that I play here in these market wizard books and so forth is to report what's happening, right? And it's just to report the truth. And the truth is that some of these traders are very successful because they take what seems to be almost reckless risk in a way, but in their mind, it's not. They're taking it at very precise times, and even in Camillo's case, he's buying options, so it's not like he's going short GameStop,
Right.
because it's $50 and he thinks it should
Unlimited.
be dead and it can go to 500. He's not doing that. He thinks he's right. He's buying options. If he's wrong, he's going to lose his option premium. So even there, he's got the risk control.
You know what else he has? He has perseverance, because look, in my own trading, Jack, you know how many times I've been early about a turn in the market, and then right before the turn, I'm already exhausted, and then it happens without me. And for him to have that type of perseverance to continue, the market will wear you out many times before what you're looking for happens. So that's a wizard's strength right there, supernatural to me.
Perseverance, and that conviction, that confidence, and not everybody can have that, and you only have that if you've developed, however you've done it, whether it's for intuitive sense of markets or some specific methodology, but you have that degree of confidence. Not only a small percentage of traders will ever have a methodology where they can really, or knowledge of the markets or feel for the markets where they can really have that level of conviction. For most people, it would be disastrous to do that because they don't have it, and nor should they have it because they don't have an approach that merits it.
Right. So, when you talk about approaches, the old argument, and it was something I was going to bring up, and you and I have talked about this before, is the argument between fundamental analysis and technical analysis. And in a prior interview, you said you preferred technical because there is at least a line in the sand. Whereas if you're a fundamentalist and the fundamentals are still good while the market's moving against you, you tend to even add on to those positions because the fundamentals haven't changed. So there's really no risk management being strictly fundamental. You still feel that way?
Yeah, you got me exactly right. And it's not only is there no risk management, it's the inverse risk management, because if the fundamentals don't change and the price is going down, hey, it's an even better buy, right?
Yeah.
So
I've done that too, Jack.
So it's tough. Fundamentals, it's hard to, fundamentals intrinsically fight risk management in a sense. And but having said that, there are plenty of traders I've interviewed who are totally fundamentalist and still manage risk. And so I don't mean to imply that you can't do it, because it's been done, and it's been done extremely well. I'm just saying it's more difficult to have risk management fundamentals, much more difficult than technical. And you have to be aware of that. And if you go down the fundamental route, you've got to figure out some way to handle the fact that you're going to get in when the fundamentals seem good, and in many cases have to get out when they seem even better.
So the trader that you were talking about that pared down size, his name again, Jack?
Oh, Camillo, Chris Camillo.
Okay. Was he one that used neither technicals nor fundamentals?
That's the name, but that was the name of the chapter. You got it. Neither.
And it's kind of based on what he sees on social networks, how many times, and stories, and he's made big calls based on that.
Yeah, tremendous calls. And he was on, he used Twitter primarily for many, many years. And since the last time I interviewed him, I spoke to him, he's been using TikTok. So, it's
everyone's going there.
So he switched, but it's always been social media. And he kind of opened my eyes to the fact that there was something other. I thought that if you have technical and you have fundamental and the mix of the two, you've covered 100% of the trading universe. Yeah. And guess what? You haven't.
He's advanced from the cover of the Wall Street Journal or Barron's, right? I mean, that's what we had in our day. Yeah. I'd like to ask about, when you're evaluating traders, and I'll bring up Fundseeder that you're co-founder of FundSeeder, where people come in and they show their trades, and you can monitor their trades. And you've done it with, you found wizards in FundSeeder for your last book. I wanted to ask you about how you analyze results. And I know you like audited statements, but a lot of people use Sharpe ratios. Why do you go to what's called Sortino ratios?
Yeah, so I use a Sortino and also the gain to pain, which is my own measure. But we'll stick with the Sortino because it's probably better known. So the problem with the Sharpe ratio is that the risk measure is volatility. And in many cases, it is a reasonable proxy for risk. And, for example, if you double your position size, your Sharpe ratio will double. So in that respect, it's a proxy. But the problem is that it totally breaks down because a lot of times volatility is not synonymous with risk. In fact, sometimes can be. In fact, there are strategies where low volatility can even be a characteristic of a risky strategy. For example, selling out of the money options. If you get a stretch of time where there's no major event, you will have this long string of every. It's like
you're collecting. You're the house.
What's that?
You're the house. You're just collecting premium.
You're like the house in the casino, or like made off of real numbers. But the catch is that what you're doing is you're walking through a minefield.
Right.
And there aren't that many mines, and as long as you don't step it as a mine, you look like a genius. But of course, you get one really sharp bear market that happens abruptly, quickly. Then all of these options that you're selling, not only do you lose, but they go from 10 delta to 1 delta. So they multiply in position. So it becomes, lots of these strategies have blown up completely. They go for years and they do well. But my point here, getting back to the Sharpe ratio, is the Sharpe ratio for the strategies is going to be great until they step on the mine. And then, of course, it's too late and it doesn't make a difference anymore. So the problem with the Sharpe ratio, it won't reflect when there's episodic risk at all. So that's one part. But I mean, you can say that's going to happen with the Sortino too. The difference is the Sharpe is measuring volatility in either direction. And you have lots of traders, or not lots, but you have some traders who have strategies where their volatility is on the upside. In fact, many of the traders, the market wizard books are probably very heavily biased towards those type of traders. Lots of the traders that I've interviewed have that profile. They have huge upsides, and particularly on this last one, the number of traders, they literally have some months where they literally make 100% in a month, but the worst month is going to be 10%. So they've got volatility, but it's on the upside. And the Sharpe ratio will say that's bad. Well, truth is, real people will not look at somebody making 100% in a month as something bad. They're just not. It's not risk in it. It's not risk in their.
I'd like 12 months like that.
Yeah,
terrible.
Well,
be terrible. Huh?
Even one is good.
And so.
But the thing is, it's that upside volatility which is penalized by the Sharpe ratio, and it is not penalized by the Sortino or by the gain to pain ratio.
So that probably took some work and time to come to that realization, didn't it?
No, I realized that I've been been around for a long time.
Yeah,
I can't even remember how long it's been since. I can go back and think about books. I wonder. I don't know if probably the original Complete Guide to Few, when I wrote the first edition, was back in '84. I'm not sure. I'd have to actually go back. I probably had it even back then. I wouldn't be surprised if even back in '84 I had that as an issue. I've certainly had it for 20 years plus, but I think it can even go back to then. Out of curiosity, I'll have to go back and check, but I think I probably even wrote about it then.
I also gleaned before the interview, I prepare, and that you were surprised that your recent wizards, the unknown wizards, actually outperformed the original or many of the original wizards, because of the different environment. You know, Jack, we used to write up tickets and
Yeah.
call in orders, and then a runner would take it to the pit, and they put the stops in one hand and the orders in the other. And with all the machines and everything, you thought it would be more difficult. That surprised you, didn't it?
Yeah, no, I went into the book assuming I wouldn't find records like Marcus or Kovner or some of those all-time greats. And I like you said, I found records that were in some cases better, and maybe among I think one of the traders in the last up and down Mark Lewis's book probably is the best trader I ever interviewed. So but that was surprising to me because I thought you've got these firms, the Renaissances and the Citadels and
Right.
you've got the firms with 100 PhD mathematicians and physicists working there, and they get an edge. But I thought in that type of environment it would become like almost impossible to generate these like stratospheric returns. And some people have been able to still do it, which is, like I say, it was surprising, but it shows it's still possible.
Do you get a feeling of deja vu, Jack, when you look at what's happening as a market observer, the big rush with commodities, a bull cycle in commodity markets that, compared to what we lived with in the 70s, maybe on steroids this time?
Well, commodities are not on steroids compared to the 70s. The 70s were the steroids of the commodity market.
Okay.
Because you think where they started them, I think of something like sugar, which was trading like 2 cents and goes up really to 66-cent high, a 33-fold increase. I don't know if you can find 33-fold increases in commodities anymore. So you had some, and gold. I mean, with gold started out sub 100 and
880
and ended up going above 1,000, 10 to 1. So I think the moves you had back in the 70s are probably bigger than anything we've had or will have at this point. But commodities, like everything else, they're just cycles. And if you look at something, it's like interesting. You can look at something like, and I haven't done this in many years, but I used to do it. Take something like the S&P versus gold, like a ratio of the two.
Yeah.
But what I do remember, even though I haven't done it, I can't tell you exactly where it is in the range now, but I remember doing it at one point and discovering that it was literally, and this is like staggering, there was literally a 50 to 1 rate, 50 to 1 ratio in a factor between the high and the low, gold versus S&P. It's like extraordinary to change how much one can go versus the other. How
it's on the verge right now, Jack. Take a look at a chart after the interview. We have seen that in the last year, and with gold railing, we're challenging trend lines.
So nowhere near. So you would have gold. I guess gold in late 79, early 80. Gold was like, let's say at the peak it was near 1,000, and I don't remember what the S&P was, but we, at the end of the 70s, we basically had a sideways decade. So it hadn't gone anywhere. And, gold had gone up tenfold. So I forget what the ratio between the two, but that was a point where gold would have been very high. Take it to the other extreme, where gold falling all the way down at the same time, you have a giant bull market in stocks, and it went the other way. Like in 2000, I don't remember what it was, but 2000, the ratio of stocks to gold was pretty darn high.
Okay, and I know this is a little bit outside, but it's fun to talk markets with you. The market's doing one thing and the Fed is saying another thing. It's a pretty good tug of war going on here. Do you feel that way?
Well, I mean, basically, over history, obviously, and everybody knows this. There's a reason why there's don't fight the Fed, is the saying, right? But it's all a matter of timing and expectations as well. So I mean, the Fed has, we've already raised quite a bit, okay?
Right.
And there probably are maybe some modest more raises coming. I think modest. I don't think he'll have a lot, but the inflation trend has already turned, and markets always look ahead. So at this point, if you're going long, and I'm not arguing long, long or short here, I'm just saying, just from the question you're asking, if you go long here, are you really fighting the Fed? Well, in most of the vast amount of the hiking, the rate hike that will occur in this cycle has already occurred. And the key thing that's driving that has already turned. It's changed its trend. And markets look ahead. You take those three facts together, is a long position now fighting the Fed? I'm not so sure.
Okay. They're, inverted yield curves that we haven't seen before. And isn't there part of the cycle after the Fed where you have to worry about credit risk and solvency and things like that afterwards? And that's why they may take rates back down?
Yeah, I mean, that's true. I mean, you do have, the yield curve inversion has, although I will say statistically, it's not that's faulty. There's just not that many. There's not that many data points. There are not that many data points, right? So you can't get tremendous statistical reliability on it because it's something that just happens, for some infrequency. But every time it's happened, there's been a recession. So I believe that's true. Is there still a recession to come? First of all, this could be an exception. But even if there is, it doesn't mean the market will necessarily go down because the move we had down may have just anticipated it, right?
Right. Right.
So it doesn't necessarily follow. If you told me for 100% certainty that there's a recession that's either ongoing already, which hasn't shown up, don't have the confirmation, or will show up very imminently, I would not from that jump to the conclusion that that's bearish for the market, because for all we know, the decline that we had in 2022 may have just anticipated,
discounted it all.
Yeah, and so anyway.
Well, they're going after the generals now. All last year they took out the troops, and now things like Apple and Microsoft, and things that people thought were safe. Apple, it was like a bond to some people, and they found out that FANGs, things come and go. You think there's going to be new leadership, and that the FANGs, we won't return back to the same type of market structure we had with growth leading, and maybe it's things you drop on your foot that will outperform.
Well, it's a fallacy of believing the past is an indication of the
future
potential return,
yeah,
and implied risk of an investment, where sometimes it could be quite the opposite. In case of bonds, you're at zero interest rates, right? So you go from a market that's been up for 40 years and came from 13% bond yields down to almost nothing, right?
Right.
So, but you're not going to go negative 13. You're not going to go, even if you want on bonds, you're not going to. But there's a limit to what you can do on the downside. So all that capital appreciation, by the fact that it looks so good in the past, is actually a negative for the future. Now, to be fair, the problem, you could have said that 10 years ago, and it took a long time to happen, but it's still a true statement. So it's sort of like the opposite of a bubble, where a rising bubble, where like the Nasdaq in the within the days of the internet mania, went to levels that everybody knew. It was just these companies were priced at ridiculous price. Everybody knew it was wrong; it couldn't last. But you don't know where the music stops, and so you could be right. You could say the Nasdaq can't go above 4,000, and which would have been a reasonable statement, but it went way beyond 4,000.
Well, I've never witnessed a severe bear market in bonds like this, and the 30 years I've been doing that.
Because it is a function of having very low rates at the same time, where then you get an inflation pickup. It's sort of the worst of all the worlds. So it's certainly totally reasonable what happened. I mean, it's not surprising at all.
Yeah, a lot of action in the FX world too, with what happened in the UK when the pound was crashing and the gilt market was dysfunctional, and in Japan where they own 110% of the JGBs, and they finally had to do something. So you a believer that the currency markets are kind of the fulcrum of the wheel and the rest of the markets are spokes coming out of currency?
Gee, I never thought about that. I mean, the currency markets are probably the biggest market. I don't know if they're bigger than fixed income or not. But yeah, you know, they're gargantuan in terms of the amount of trading that occurs. You know, kind of all in the bank, obviously. Whether they're the driver or not, it's hard to say. You know, both fixed income and currencies are basically reflective of the economy and government policy. I don't know if you can differentiate, you know, which is more, and they both will, you know, react to the same thing. So I don't
Yeah,
know if you can say which one's the driver.
it's like the chicken and the egg then, with
Yeah, I don't know.
with debt,
I
and
can. I don't
currency.
know. I
You
don't know
know,
which one's the driver.
something else I discovered, Jack, and you know, how many interviews would you say you've done in your career throughout your series of books?
Oh,
Ballpark.
ballpark. I don't know. 500. I don't know.
Okay,
I have
well,
to admit.
I found out you never script your interviews. You might have on a tablet like I do right now, a few questions that you maybe you have in mind that you're going to ask your guest or whoever you're interviewing, but most of it is spontaneous, isn't it?
Would I interview people?
Yeah.
Oh, sure. Yeah. So that's kind of important. I do prepare questions as a just a backdrop, so that when I finish interviewing the person, I can look and see if I've missed any of the points I did want to raise.
Okay.
But my approach to interviewing is to have a conversation, you
Yeah.
know, and it's important for two reasons. One, you don't want everything coming out, well, more than two reasons probably. But first, you don't want to have everything coming out like it's, you know, the same, right? It's also very important because if you do an interview that way, then a lot of times it will come out very stifled, very boring, you know, very blank, because you're just knocking off the checklist, and it's not engaging. And that engagement is important because as an interviewer, you probably know this, you have to listen to what the person is saying, because let's say in the Market Wizard books, some of the best stuff I got in those books wasn't because of questions I had in mind to ask. It was because I listened to what the person was saying and was willing to go then off on that tangent. And
That's
that
the
is
good stuff,
critical.
Jack. That's the
That's
good
the
stuff,
absolute
right?
critical.
Because that's the creativity and the spontaneity, and I enjoyed doing that with you today.
Yeah.
Yeah, and I
Yeah.
learned
So it's a good conversation because it's a conversation.
yeah,
It's
and
not. And
I
I've been on the side of, you know, people come in with their, you know, and you can tell they're just waiting for you to stop talking so they go to the next question.
yeah, and
And
I've actually had guests ask me if I could send the questions prior to the interview, and I go, no, I don't script them.
yeah,
So
I
yeah,
actually, and on my end, I get people who ask me, "Do I want the questions?" They said, "Please, no, don't send me the question. I don't want to know what you're going to ask," because, you know, then that just makes that stifles it. It's just you know, I don't want to even think ahead. I prefer to just go off the cuff on the answer.
well, you're a great ambassador for the trading business, Jack, and you've edified many people over the years, and I'm so glad our paths have crossed because every time I talk to you, I learn.
Oh, I appreciate it. It's good
So
chatting with
everyone,
you.
Jack Schwager, people could find you, Jack, at Fundseeder if they think they have it within them that they might be a future unknown wizard. Do you
Yeah,
encourage people to send their
right.
statements? And okay, so you go to fundseeder.com and you can follow Jack on Twitter. Are you active on Twitter
Yeah,
anymore?
I'm semi-active. I have a Twitter account, and I do post. I don't post. I'm not one of these guys who post all the time. I post occasionally, you know.
Okay.
And there are times where I post more often, you know. So there are times of like a book coming out, I may
Right.
post everything for quite a while.
All right. Well, you let me know that by email. All right, my friend,
Yeah,
when your next book is coming out,
I'll
because
let you know.
we all look forward to hearing you and reading you, Jack. Thanks very much for your time. It's it's become my most precious currency, time.
Yeah, well, we're in the
Yeah.
same age.
Yeah. So thanks for spending some with us today, Jack.